So picture this. March 6th, 2026. The market gets absolutely gripped by this sudden, violent wave of fear. And the big question wasn't just what happened, but really, how could one single event send Wall Street into a complete tailspin? And maybe more importantly, where did the smart money run to hide? This number, yeah, that's the sound of pure panic. It's the one-day explosion in the VIX, what Wall Street calls its fear index. A jump this big, this fast, it tells you one thing. Professional investors were scrambling to buy insurance against a crash. You could literally feel the fear in the air. And this wasn't just some vague feeling, right? It translated into very real losses. The S&P 500 dropped 1.3%, and the tech-heavy NASDAQ, it got hit even harder, falling almost 1.6%. This was a classic risk-off day, just widespread selling. So what on earth lit the fuse? Well, the trigger wasn't a bad earnings report. It wasn't some data release from the Federal Reserve. Nope, this was a geopolitical earthquake. A military flashpoint in the Middle East with the codename Operation Epic Fury sent these immediate shockwaves right through the global financial system. All of a sudden, the entire market calculation had this new, unpredictable, and frankly very dangerous variable thrown into the mix. So what was the most immediate economic fallout? A massive, massive spike in oil prices. I mean, in a single day, WTI crude oil skyrocketed over 12%. A move like that is almost unheard of. And of course, that instantly stoked fears of a brand new wave of inflation about to hit all of us, consumers and businesses. But here's the thing. This wasn't just a simple inflation scare. At the exact same time, the market got hit by a second, totally contradictory piece of bad news. And that created this incredibly confusing and dangerous dilemma for pretty much everyone. And here is where it gets really messy. On one hand, you have the oil surge, which is screaming inflation. That's usually a sign the economy is overheating. But on the other hand, a weak jobs report comes out, and that's screaming recession, a sign that things are cooling down way too fast. This is the absolute nightmare scenario that we call stagflation, and it puts the Federal Reserve in a completely impossible position. Just like the Motley Fool said here, this really could be a tipping point. And why is that? Because the Fed was now caught in a policy trap. If they raise interest rates to fight that oil-driven inflation, they risk totally crushing an already weak economy. But if they cut rates to support the weak job market, they risk letting inflation just run wild. There were just no good options. Okay, so in the middle of all this chaos, you've got inflation fears, recession fears, geopolitical turmoil. Where did investors actually go to find some shelter? I mean, with the major indices deep in the red like that, you would totally be forgiven for thinking everything was just crashing and burning. But was it? And the answer, which is fascinating, is no, not at all. There was this really stark reversal happening under the surface. While sectors like aviation and travel were getting absolutely crushed, money was rotating. For instance, General Dynamics, a major defense contractor, was actually getting stronger, moving towards what traders would call a buy point. This brings us to a really key concept for understanding these moments of panic. It's called the geopolitical hedge. The easiest way to think about it is like a very specific kind of portfolio insurance that pays out not when the economy slows down, but when global conflict heats up. So in this crisis, the money flowed into two classic geopolitical hedges. First up, defense stocks. Makes sense, right? With military action underway, investors are betting on increased government spending. And second, energy stocks. In a conflict that involves a major oil-producing region, well, the companies that pull that oil out of the ground suddenly become a whole lot more valuable. So what's the big lesson here that we can use again and again? Well, this event gives us a perfect framework for understanding how markets react under pressure, and maybe how we can think a little more clearly when that panic hits. Psychologists talk about two systems of thought. System one is our gut reaction. It's fast, it's emotional, and it's totally driven by scary headlines. War in the Middle East, sell everything. That's a system one response. System two, though, is slower. It's more analytical, it's rule-based. It asks, okay, given this specific event, what assets are likely to benefit and which ones are going to suffer? The market's initial reaction was pure system one. How do we know that for sure? Well, the VIX jumped over 24%, while the actual market indices only fell about 1.5%. Think about that. The fear of a crash was many, many times greater than the actual damage. That huge gap, that's the emotional amplification of System 1 at work.
So, how do you engage that logical system two when all the alarms are blaring? It really comes down to a simple three-step framework. First, just pause. Don't react to the headline, look at the actual data. Second, follow the rules that you made for yourself when you were calm. And third, trust your portfolio's design. Trust that you've already built in the right hedges to handle shocks exactly like this one.
And that brings us to the final and most crucial question that this whole thing forces us to ask ourselves. The market panic of March 2026, it wasn't the first, and it definitely won't be the last. So when the next shock comes, is your portfolio prepared for it?